Good afternoon. This is Chris Walker with TokenSoft. We're a provider of technology services for asset issuers in the blockchain space. And what we're looking at today is the tokenization of credit instruments. So this is something that was really intriguing to me personally, because if you look at the four fundamental asset classes out there, we've seen a lot of activity in crypto in the first three, and I think 2018, 2019, we're really starting to see activity pick up in the fourth one, credit. So if you break down all the assets out there into things like currency, so the US dollar, a tangible asset, that might be something like a house or a barrel of oil. Equity, this would be something like ownership in some abstract revenue generating entity like an LLC or a C Corp. So basically the right to future revenue generation from that abstract entity. And then you can think about credit as the right to future income streams from value that you've provided in the present. Like what's interesting about credit is it's basically a way to shift value forward or backward in time, where I can make a deal either with myself or another counterparty, and I can say, I'm going to give you value A now, and in exchange, you're going to give me value B later. And what's interesting about these basic asset classes is we're starting to see analogs for them in DeFi, or decentralized finance. So if you look at currency, the clear analog there is cryptocurrency. Tangible assets, like a house or a barrel of oil, we're seeing things like utility tokens and what NFTs, or non-fungible tokens, like a CryptoKitty, that represent sort of the virtual or digital form of a tangible specific asset. The clear analog to equity is the security token, and this is something that our company specializes in helping issuers take their equity and represent it on the blockchain. But the last one there, I put a question mark because I don't think it's yet clear what people in this space are going to call the biggest credit applications yet. So what I want to do is I want us to imagine credit instruments as Ethereum contracts. And so we'll do this in 3 steps. So one is we'll look at traditional credit instruments. And I'm going to dive in pretty deep here just because I wanted to really understand this space and I don't have a financial background. 2 is we can look at a couple of blockchain credit projects. And 3, we'll discuss what would it take to make an Ethereum token standard that could represent a really broad variety of what we could call debt or credit or fixed income like instruments. Okay, so first, traditional credit instruments. The simplest one, we're going to go through all these, is the bilateral loan. Then we'll move on to Treasury bills, Treasury notes and bonds, syndicated loans, and bonds. Okay, so each of these is going to have a simple diagram, and you can see on the left there, as time increases, we're moving down this diagram. A bilateral loan just means there are 2 parties, and like I said, they're shifting value in time. So basically, the borrower wants the value now, the lender has the value now, and the borrower is promising to return that value to the lender at a future date. So the lender, basically, these people sign an agreement, the lender transfers that principal to the borrower, and then later on, there's 1 or more payments from the borrower back to the lender. And there's a lot of questions you can ask about these loans. Like the first obvious one is it secured? And what that means is if the loan is collateralized or secured, then there are specific assets that are sort of held in reserve so that if the borrower defaults on their obligations, the lender is not out of luck, they can then seize those assets. And so that helps people extend that trust. The second interesting question is this a security? And the answer really depends on the facts and circumstances. Some loans are securities, some may not be. So moving forward to the Treasury Bill, this really looks like the exact same thing, except that in this case, the borrower is the federal government. And another interesting note is that the investor, so you see there $1,000 face value. If you have an investor who is loaning money to the federal government, he's getting paid back the face value on that Treasury bill. So the federal government might say to you, say January 1st, 2019, we are issuing $1,000 T-bills that are going to be due June 1st, 2019. But the investor there is not going to buy them for $1,000. He's going to buy them for, say, $990, and then he's going to get paid back by the federal government $1,000 6 months later. Another thing to note about Treasury bills is that they are securities, but they are non-transferable or non-marketable. And that contrasts to Treasury notes or bonds. So here the time frame is longer. Instead of under 1 year, it's 1 to 30 years. And so here I've illustrated what would happen if we had two potential investors for a Treasury note or a bond. So let's say that I'm the investor A, and I would like to invest some funds with the federal government. And so the federal government is issuing, let's say, a 30-year bond. So they're going to have an open market auction, and you can do this at treasurydirect.gov. These things are all electronic already. And so I can participate in this auction. I can buy some Treasury bonds at a certain face value, let's say for 30 years. And then once I do that, the federal government is going to start spending or sending me interest on that bond. It's going to happen biannually, and they actually will set it up with direct deposit so that it'll show up in my bank account. Now let's say that I wanted to sell that bond that I've purchased. So I could find an investor B, and they could buy that bond from me. And there's like a standard form you can fill out to do this. It's like form 5122 or something. And once that happens, the federal government, through Treasury Direct, knows that this instrument is held by a new investor. And so then they then direct the flow of interest payments to that new investor. And then at the end of those 30 years, I believe the face value has to be repaid to that investor. So this one's a little more confusing. Any questions on this?
Comment.
Yeah.
You can also do this at Fidelity or Schwab, and you don't have to deal with Treasury Direct.
Got it. Yeah.
And your interest payments will be deposited directly into your brokerage account.
Got it. Now, does Fidelity take a cut on that?
No.
Okay. Awesome.
So can this investor B sells to investor A?
Let's see.
Other way around.
Okay.
Investor A sells the
You're right.
bond to investor B.
So the arrow is the direction of the cash,
Okay.
not the security.
I
The
see.
word there should be purchase. Investor B is sending cash to investor A.
Also, don't buy one of these.
Thank you, Jordan, our resident non-financial advisor / financial advisor. Okay, next up is the syndicated loan. And so this is where we have, let's say, like a pretty big company. I think Tencent did this. It was like a $5 billion syndicated loan I was looking at in 2017. And so they used it to acquire a bunch of companies. So this is a fairly risky business activity, and it's a bit too big for some banks to want to have on their balance sheet all on their own. So what happens is our borrower, let's say it's Tencent, they'll go to what's called here an arranger. And the arranger could be a bank. It could be what we're calling the agent here. It could be participating, it could not be. But anyways, the point of the arranger is going to go out there and it's going to sort of figure out what the market interest is for this loan. Once it knows what it is, it goes back to the borrower, here we'll say Tencent, and says, look, I can get you this loan, $5 billion, we'll say at 4% interest per year. Okay, so the borrower agrees. Then all these lenders that the arranger finds and markets this to basically act together. So there's some really interesting legal details about this where the debt from the borrower to the lenders is not joint. It is several, I believe, which means that technically it's like each debt from the borrower to the lender is a separate obligation. But there's some interesting game theory that's used here to force the lenders to act together. So let's say the borrower is misbehaving and I want to sue them as one of the lenders, but I only own 3% of this debt. If I sue them and I win that lawsuit, which I can do, I'm only going to get 3% of the proceeds. So it really forces the lenders to work together as a whole. And then in between the lenders and the borrower, you can see an agent here. And basically the agent has obligations to both the lender and the borrower. to communicate the state of the loan, like is the borrower in default right now, and to transfer funds. So as the borrower is making payments on this loan, like let's say the borrower goes into default, the agent has to notify these lenders, FYI, 10 cent is currently in default. And then the lenders get together and they decide what to do. And let's say that they want to go after this borrower. So they have what's called a trustee. And the trustee is the one that they would all vote and say, you as the trustee need to get these proceeds by forcing our borrower into bankruptcy or something like that. And so the interesting thing about this is if you look at this diagram, things like the arranger, that's sort of like a marketplace. The agent is sort of like a source of truth on the state of the loan. And the trustee is sort of like something that can hold assets and collateral. And you can start to see how some of this might get tokenized. So this diagram is going to look a little similar to one we'll see later. Okay, lastly, for a bond, this would be something like a really big, really trusted company like, well, I would say GE. Maybe GE is still a good example. They want to do some generic R&D. They need a bunch of money. So here what happens is the issuer, like GE, finds an underwriter. And in this case, it's sort of like an IPO, except rather than equity getting put on the public markets for the first time, it's debt. And so this underwriter purchases the principal, the amount that the issuer is offering. So let's say the issuer is creating like a $100 million bond. 1% of that might get eaten up by underwriting fees. So maybe only 99% of that actually gets to the issuer after this initial offering. So the underwriter promises to pay the issuer. The underwriter then goes and markets this to these lenders. There's an initial offering. The lenders choose to buy it. And then there's another thing here where we have to track these payments after the place. Because where I have capital markets here, you can think of sort of the public market infrastructure in the US, like DTCC, like Fidelity, and so on. These are all the players that help track who owns securities. And so this issuer needs to keep making those payments to the current owner of that bond. And so these lenders can then transfer or sell, I have here, these bonds between themselves, and they should receive payments until they're due. Okay, so that's a broad summary of kind of an example set of traditional debt or credit instruments out there. I guess any questions on this bond one? Or any comments? Okay.
So the issuer is basically paying payments to, let's say, DTCC, Fidelity, and Schwab have investors that hold their bonds at those firms. They would send a payment to Fidelity, and then Fidelity would distribute the interest payments.
Yeah.
As opposed to sending 1,000 checks, they would send 3 checks, let's say.
Right, and so I tried to find this out, and I'm honestly unclear if the issuer pays to DTCC or to like more fine-grained things like Fidelity. Because like DTCC is supposed to be the central clearinghouse for all these securities.
Yeah, or like computer share, they do that for equities.
Right.
So like the issuer, like IBM, would say, okay, here's the dividend payment for the benefit of computer share or to computer share's account, and then computer share would have $1 million for the benefit ofs that they would then distribute the proceeds to. And that would be their role.
Got it. And everyone in the crypto space, when you hear something like that, thinks this is something that can be disrupted, right? Like a ledger tracking who owns what is like exactly what crypto's for. Okay, so looking at a couple blockchain credit projects, we've covered MakerDAO previously, so I'm going to go over this one really briefly. But MakerDAO is essentially a fun idea of a central bank merged with a commercial bank. There are 2 tokens involved. There's MKR as equity, and then there's DAI as the roughly $1 equivalent stablecoin. And it's basically debt that must be paid back into a collateralized debt position in the future. So the way that this thing gets generated, the DAI, is you open up a CDP or collateralized debt position. So if I want to go long Ether, I can then take a bunch of Ethereum, put it into a CDP, withdraw a DAI that's fully collateralized by this Ether, and then I haven't sold my Ethereum or generated any taxable events like that, but I've got some liquid funds if I want to go spend that DAI, or if I want to use that DAI to then go buy more Ether so that I can be really long Ethereum. The interesting thing here is there's not really a clear counterparty. So like I said, the fundamental thing about credit is like making a deal with time. The counterparty could be another person now, or it could be yourself in the future. And then quick illustration of this, if you look at how a MakerDAO CDP works, it's a user on the left, that could be me. I would like some DAI, so I put Ethereum into the CDP inside the MakerDAO ecosystem, and then I get DAI in return. And if I'd like to get my ETH back, I'm going to need to return that DAI along with a stability fee. Any questions on this one? Cool, yeah, we just covered this like a couple weeks ago in more detail. It was fun. Okay, so the other one that I've been looking at briefly is Dharma. And this is a pretty cool project that just seems to have taken off recently. And it's basically a platform for crypto borrowing and lending. And so there's a couple kind of key concepts they have here. So one is a terms contract. And so in traditional credit instruments, you'd have a legal document describing, how often you're repaying this thing, what's going to happen if you default, and so on. But none of that has a really good equivalent in crypto land because there's no legal recourse. So the terms contract has basically a string that you input into it, like literally a hex string, that defines, like, this is a 3-year loan, it is for 10 Ether, and the collateral is 20 Ether held here. So you literally are setting up your loan by defining in a hex string the terms. Then there's this idea of a debt token. And so, like, let's say that I trust Jordan a lot because these can be fully collateralized, like DAI, or they can be unsecured. So I could just literally trust Jordan. So let's say I trust Jordan and we get into a contract and he says that he's going to repay me 10 Ether in 1 year. So this creates a non-fungible debt token because this particular kind of creditor and debtor relationship, this particular loan, is not like any other loan out there. So you can't use a fungible token to represent these. Then let's say that Jordan needs to repay me. So I've said that he needs to repay once a month. The way that works is they have basically a router contract. And so every month, Jordan is going to send Ethereum to that Dharma router contract. It's going to find out who the current holder of that debt token is, and then it's going to send the funds there. The other thing it's going to do is it's going to mark in the terms contract that he's good for that month, that he's paid as necessary. And then the last thing here is defaults. So this can happen. And the really cool thing about Dharma is you can programmatically check if someone's in default. So you can basically query the smart contract and say, is the amount paid greater than or equal to the amount that should have been paid? Yes or no. And if no, I as the creditor can run a function. I think it's called like claim collateral. I forget the exact term, but basically where you're clawing back all the collateral that they promised for that loan. Okay, this one's complicated. I'm trying to illustrate here how Dharma really could work. And so here, let's say that I'm lender A, and then Jordan is the borrower. So the first thing that Jordan might do is he wants to create this loan. And let's say that for his 10 Ethereum loan, he has, I don't know, like 1,000 DAI as collateral. So he's going to deposit that collateral with Dharma. And then I need some way to find out about this loan. So in Dharma, there's this concept of a relayer. And this is a party that can take a fee for passing on information about loans that I could enter into. There's also a concept of an underwriter, where let's say that this loan is unsecured or undersecured that Jordan's making. you might want an underwriter like James here to say, yeah, I trust this guy. Oh, James is shaking his head. Like Mason here, say, yeah, I trust this guy. He's gonna make good on his debts. Like, and they'll actually cryptographically sign this debt instrument before it gets to the relayer. So then I, as the lender, see this. I look at the underwriter. I say, I trust that person. I look at the deal terms. I agree. So then I will pay my principal into that loan, and that gets to the borrower, Jordan. Then, as this goes along, Jordan can make payments which go to the relayer in the Dharma contract, and then that payment is relayed to me or whoever owns the NFT, the token, what are we calling it here? The debt token at that time. And so here you can see I as lender A, like let's say I sold this token to Greg, and maybe this happened on Binance. It could be on any exchange that supports this. So I sold this token to Greg. He's now the one that's going to be receiving those payments. Any questions on this one?
Can
Yeah.
you break down the debt token further?
Yeah, so we could actually look at it in a little bit. So we'll try to do that. But really quickly, let me.
So from my understanding, this system would be a closed system. So let's say I wanted to create my own debt market as Jordan's, debt market LLC. I would create the system where I would have underwriters, I would have relayers, and people would come to my marketplace in order to find borrowers and become a lender, as opposed to Dharma being the centralized party that's creating the market. Which is why right now, if you want to be a lender or a borrower, like it's very, very fixed terms. You have to have an over collateralized position, like 150% or something like that. But I was asking like, do you expect like financial institutions to start, like using this open system? And they're like, no. They would basically implement this system in their own private system, and it would help reduce friction of, this process. Was the understanding that, or the impression that I was given by them.
Yeah, so I know a lot of this stuff with underwriters is still pretty early, and they like have warnings all over the place, like, hey, this is genuinely an unsecured loan, like tread carefully. So I don't know how far along the underwriters have gotten.
I mean, if you're talking about like trust, right, wouldn't that imply sort of like KYC? Like you'd have to know the person that's behind the signature.
Right. So I think the idea is the underwriter is definitely a trusted third party. And so this would be something like the crypto equivalent of Fidelity. Says we've audited this borrower, we trust them. And then at that point, if you trust Fidelity, okay. And so this is the actual debt token that they're looking at. And so it's like at ER 721 and so on. And it looks like Mason's taking a picture, and then we'll jump back into our regular presentation. Okay, so the next thing I tried to do is consider like what all of these use cases across traditional credit and tokenization have in common. And I think 3 of them are really clear. So one is the token has to be tradable. And it's something generally like a security. So you'd be looking at a standard like ERC 20. The next thing is it's not fungible because like no two credit instruments are alike. It's, I think, even less fungible than equity. And so you'd be looking at ERC 721. And finally, we saw you'll need transfer restrictions. And so we've seen this with bonds and with syndicated loans, especially with syndicated loans. There's pretty commonly a whitelist or a blacklist of parties that are allowed to participate in that syndicated loan. And so contract standards like ERC 1404 are already set up to do exactly that. But there are also some new challenges. So these are things I don't think anyone has really come to consensus on, is how these should be represented on Ethereum. And talking to the folks at Dharma, it sounds like they really had to build their own contract system because these were not standardized. So one is the payment schedule and history. If we're talking about a credit instrument, I need to know, like, what's the coupon or interest rate on this thing? Is it going to repay the entire thing? You know, is it going to be a lump sum payment at the end? And then I need to look at the history. Well, if this borrower is claiming that they've made these payments, have they actually done it so far? And hopefully I can do that in a fairly trustless way. The next thing is collateral. So sometimes we've seen with Maker and Dharma, there can be on-chain collateral like DAI or Ethereum. But the world of credit instruments is much, much bigger than that. And so there probably needs to be a way to represent collateral whether or not it's on-chain. Then income stream routing, you need a way to track the current owner of this instrument and how they need to get paid. Because you can't be having their coupon or interest payments getting lost in the ether. And finally, renegotiation and default. So default is a bad day for everyone in general, but it happens with credit instruments. And another thing that will happen, especially with things like bilateral loans or syndicated loans, is the borrower uses those instruments because they know that they're in a risky business and they know that default, there's a decent chance of it. And so they'll actually create a syndicated loan. And then, like, let's say business doesn't go as planned, they'll go to their creditors and they'll say, look, like, we can do bankruptcy or we can renegotiate this thing. And so I think it's an open question whether or not a token standard here would need to have some means of renegotiation in it, or if you would simply like destroy the token and make a new one. So I guess I wanted to get the thoughts of folks here that if you have any ideas for like how these things could be represented on Ethereum or which of them seem key.
The income stream routing one is interesting to me.
Yeah.
Because we've seen this before with other problems where you have a token that represents ownership, and like with this it'd be like, okay, on January 1st, midnight, we're gonna send all the token holders their percentage of the dividend. And so it's like, that's very easy to game, right? So either you do it off-chain and somebody off-chain gathers the balances at that point in time and then manually sends them out. But if you want it decentralized and on-chain, it's much harder to do because you can't guarantee that like all the payments would go out like at one point in time or be allocated and calculated at one point in time. So like if there's, say there's 1 million owners of this debt, like you can't get that into one transaction to calculate everybody's ownership percentage. So there's other approaches that are sort of interesting, like the mini-me token, where you actually fork off a token from another token and it tracks the balances of all the token holders at the time of the fork. And then you say, okay, this sort of fork token has all the balances at this specific block, and this is what we're going to use for allocation and income. Basically, it'd be like how many tokens you hold at this point in time when it forked is what the percentage of the payment you get.
Okay, so this is not the chain forking, this is just the token.
This is a token, yeah. It's like a token contract where you can split it off at any point in time and it will split off the balances of the original token at that point in time.
It's like a shadow?
Like, what's that?
Like a shadow?
It's
It's a kind of shadow.
just like a copy of it at a specific point in time. And then you can restrict the trading on that as well, right? So it splits off, it says here's everybody's balance at this point in time. Nobody's allowed to move any tokens, so therefore we know specifically at that block who had what tokens.
Got it.
Because like the analog to that is like voting. So like, how do you do a voting window and allow people to vote based on how many tokens they have? So I would vote and then I'd just move tokens to another address and vote again, double voting. So it's like, it's easy to game stuff like that when you're trying to do things based on how many tokens somebody holds.
So it forks to another actual contract, token contract, or just the state within a contract?
It creates another contract, but then it references the old one and keeps track of the balances through the old one's state. Basically, every time you do a transfer, it records the transfer so that it can reference the balances at specific blocks.
But a lot of these instruments seem like the income stream is really like spread apart, like biannual. So if you had, say, a whole quarter to make these payments.
Right, but you always have to have, in like stocks and stuff, you have an ex-dividend date.
Right.
It's a very specific point in time. It'll be like close of business on January 5th. And that snapshot in time is when you calculate who owns what percentage of the stock, right?
Yeah.
Because if you said, well, I'm gonna make these payments out over the entire quarter, and then people are trading that entire quarter, how do you calculate?
Right. So you need some way to freeze a snapshot to verify who should get the payments for that period.
And like in my mind, there's two ways to do that. One is to do it off chain and just have, TokenSoft say, James owned 10% of this token at that point in time, but then that's off chain, so you can't really like audit it.
You can do ZK rollups.
Yeah, but also though, with debt, let's say that the interest payments pay biannually, and it is May, and I sell you my rights to income, which is the debt contract. I get a prorated amount of that added into the price that you buy that from me for.
As in that's expected, or that's literally sent to you as
Does
an
that make
extra
sense?
check?
Usually the
No,
market
it's
just makes that.
it's factored into the price that I sell it to you at.
Yeah, but that makes sense.
But it happens automatically, like I as the person who's selling it don't have to think about that at
Well,
all.
that's because you're using the market price, right?
Yeah.
Yeah, it's just like the day after the ex-dividend date on a stock, the stock usually goes down by that
Yeah.
ex-dividend amount. Otherwise, people would just buy it and then sell it the next day, right? Capture it. So
Yeah.
Yeah.
So you're saying that would just be, like, what system's gonna factor into that?
the market
Like that could be
But what if the
solved.
market's not very,
arbitragers. They'll
okay,
say Jordan's selling this thing for way less than he should. I'm going to buy it. I'm
Got
going to get a fat dividend payment 3 months from now.
And so for something like an ERC-20, like you would always have an address that you could throw money at, right, for income streams. But I'm wondering if that would be reliable enough. Like if you need some check, like, hey, do you still really control this address? Can you actually receive funds here?
Be like a perpetual bond, and then all of a sudden the person loses the account, and then the bond payment goes into that lost account forever.
I mean, you could also just like, if what you have, right, is not actually transfer it, but just have, like a lot of different ways, have some other contract that's tracking some state as like a pull, right? Like, we'll throw it in your account.
Yeah, I mean
Whenever
we're
you're
saying
ready.
we're saying push money, but Ethereum's always a pull model, right? You
No.
never want to send funds to somebody else like in a payment that you are sending stuff. Like if you have a million holders of your bond, you're not gonna push out 1 million payments, right? You're gonna put all the money in one smart contract, and then those people are gonna have to request to withdraw it, and it'll have to calculate how much they're allowed to withdraw.
I mean, but that's, you're worried about like people having malicious contracts, but if you're not as worried about that, you could have something, right? Because like, I mean, presumably if it's a bad contract, there could be some gain. Like it could be, someone could grief your contract if you have push
Right, but
payments.
I'm saying you wouldn't want to pay for the gas to send all those payments out.
Right, but we're not. I think we're trying to do that. There's all sorts of.
I'm saying in general, you'd never send funds out to all the holders, I don't think.
So if it's set up as a pull, then you would say, hey, there are dividends or interest waiting for you.
Yeah.
Claim it whenever you want.
Yeah.
Or don't.
And then when you claim it, it has to know how much you're allowed to have.
Like with ZK Snark rollups, you could do it in this sort of semi-off-chain. So not off-chain in the sense of like you still have access to your funds. You need a little more computation, but it's not like it's probably cheaper than gas. And you can still like publish it to on-chain in kind of one fell swoop, and then everyone knows the state at once.
Yeah, then there's no reason to do a ZK whatever if it's off chain.
Yeah, it is because you have more efficient verification. That's why the ZK Snark, because it's just efficiently verified.
I mean, I don't think this is getting a very esoteric conversation, but either you do it on chain, so the chain knows how much each person is supposed to have, or you do it off chain if you trust somebody.
This is in the middle.
So,
Well, esoteric is what we're here for. So what about the collateral? Like, does it make sense to represent off-chain collateral in a token standard, or should it only be on-chain? This is something I've been wondering.
What would be an example?
well, like a security token would be
Off-chain.
off-chain collateral.
So on-chain would be DAI, off-chain would be your house. Right, like your
Yeah.
house is now collateral. It seems like the only way to make off-chain collateral work is if you have like a trusted third party in that jurisdiction who like has incentive to sue them and get the collateral.
So it's not like a bearer instrument where you can basically prove that you have it on chain.
Right.
Then you need another layer of jurisdiction, or you want to call it, to actually enforce that.
Somebody needs
Someone who has an incentive to.
to prove Chris signed away his house.
Right. Well, I'm
Prove it
certain-
and then enforce it too, right? It's like that's not the keys.
Yeah.
Like kick down your house with.
Yeah, that's a bummer. Don't lose those keys. And then any other thoughts here on like the default or like how to represent a payment schedule? Let's see if we can look really quickly at the equivalent here. So here's the Dharma term contract, and you can see they're representing things like hours, weeks, months. They've got amounts. Of course, you got to use Unix timestamps.
Mhm. We all know not to trust the timestamps in Ethereum.
Why?
Because they can be fudged one way or the other.
Does anyone have like a timestamp oracle going? Like a time oracle to get real time?
Why don't they use Bitcoin as like the central time?
Age of Bitcoin.
It just exploded. I don't know.
Like like the time in was it London?
Alright, I'll see you in one block.
Yeah.
5 minutes or 3 days.
Yeah.
Yeah, I mean, so what we're saying is like number of blocks might be a noisy signal, but it's really trustworthy, right? Yeah, so I haven't had a chance to dig into these contracts too much yet, but I would like to do that because they're pretty interesting and they're all public.
They actually have comments.
Yeah, it's great.
Awesome.
All right, and
Do
that's
they
all.
use funny names like Maker does? 3-letter acronyms for everyone?
Thankfully, I didn't see any funny names in there yet. And as always, thanks for your time, and please feel free to contact us at info@tokensoft.io. Thanks, guys.